the record button. As always, if you're in witness protection, please turn off your camera, that sort of thing, right? So today's presenter is going to be our good friend. We have the same barber, clearly. Garrett Smith with Minute Mortgage. Garrett, how are you doing this morning?
It's been 20 something years. I'm still coming to terms with it, man. You gotta come slow with it.
Yeah. For me, it was the COVID haircut, right? Bed frame landed on my head, cracked my head open, trying to figure out if I needed stitches or not. And then people are like, "Oh, you look good," and I'm like, "Oh yeah, really? All right, okay." So COVID cut, that's what I got.
Awesome.
All right, I'm gonna do the thing so you can share your screen with us. You got a little PowerPoint going?
Don't have a PowerPoint. I'm just gonna run through a couple of key points. I think a lot of people get bored and mundane with the PowerPoint, so would much rather this be a talking conversation and kind of going through some items, because we all know that in this environment, well, everything's normal in the economy right now, right? Like everything's business as usual the last couple of months.
Yeah.
Yeah.
Maybe. Guess it depends on who you talk to.
Yeah, it does. Yesterday, I have a lot of knowledge in the builder world, and I still have a lot of builder friends. And one of our builder partners here in Orlando, that I will remain unnamed, 26% of their pipeline is currently priced out of the homes that they've purchased because of interest rates. And this is not a small lender. This is one of the big dogs. So I've been working with them through solutions, and sometimes you have to get creative. The traditional vanilla programs, the conventional, the FHA, the VA, the USDA, those aren't going to work. So you have to get a little bit in tune with what the environment has and what you can do. And one of the things I know we're going to talk about today is down payment assistance, and it is a great program for some buyers. It is also not a great program for some buyers, and this is in tune with one of the customers we talked to yesterday. So this lender, or this builder, they said, "Hey, let's put them on the Hometown Heroes program," which anybody hasn't heard, that is a program for hometown heroes in the state of Florida, where they can get up to $25,000 or up to 5% of the down payment towards down payment assistance. And I said, great, let's look into it. There are some nuances associated with it. This person had over $100,000 liquid in the bank, and just wanted free money. It's not free money. Has anybody ever gotten free money from the government before?
Well, the COVID thing, with that whole thing going on, I got like $500 for my kids and stuff like that.
Yeah,
now next time came,
Yeah, you'll pay it back. Don't worry.
Well, that is essentially it. So I've always been under the impression that there's no such thing as free money. It's always going to be a caveat associated with it. So what I did is I went with this builder partner, and I showed them the difference between, and they're getting a really good concession loan from the builder. It's an FHA loan, and they're getting 6% full from the builder. So it's a significant amount of money. With any of these down payment assistance programs, there's going to be two things that are going to come along with that are going to increase cost. Number one is there's always going to be an origination fee. Typically it's between 1% and 1.5%, depending on that provider. So that's money the buyer is going to have to come up front. Number two, the interest rate is going to be higher. So that could be anywhere. In the better times, it used to be a quarter point. Right now, it's usually with a well-qualified buyer, it's going to be 3/4 of a point, possibly more. So if you amortize that, I'm sorry?
Just to kind of break down, give us some examples, like, to you and I, and I'm sure a lot of people on this call, like, yep, it's making perfect sense. Okay, great. But I know there's some newer people on the call. So can you give us like some 4 examples? Like, for instance, you said, okay, 1%, like just back it up and like give us like 4 example, right?
Yeah, and that's this example. This is exactly where I was going, exactly there. So
okay,
the bald brother is in my mind. So,
there we go.
So I broke down the payment for this buyer in two scenarios. One, with using that down payment assistance funds. And then number two, using the closing cost concessions they were getting to not only buy down the rate, but to flip them to a conventional loan and buy out the mortgage insurance, which if you didn't know, you can do that. So there are multiple ways to provide mortgage insurance to a buyer.
And
You can pay
what's
it
the
monthly.
mortgage insurance?
So anytime you put down less than 20% on a conventional loan or forever on an FHA loan, you're gonna have to have mortgage insurance associated with that. So it could be hundreds of dollars a month. I've seen mortgage insurance cost someone $600 a month.
Okay.
Just because of credit scores and things like that. So it's a cost that you're gonna have to pay.
On
So
average, like what, like for a $300,000 loan, average credit score, like what are we talking?
if you're talking a 700 credit score, probably low hundreds a month.
Okay, okay.
Yeah,
Thank
so
you.
that would be about it. And if anyone didn't know, FHA, mortgage insurance, unless you put down at least 10%, is the gift that keeps on giving. It will never go away. So it's always going to be there. It's like my ex-wife; she's always going to be around. So looking at the advantages between buying down the interest rate and buying out the mortgage insurance and doing the down payment assistance program, this buyer was going to save $9,000 over the course of the first 36 months. So it was a much more advantageous process for them, and they had the money. That's the thing that killed me the most, was that they had, 6 figures plus in the bank, but they wanted to get the free money, which would have ended up costing more money. So it's that old adage that, you kind of get what you pay for, and you got to look into it a little bit, because the initial solution may not be the best solution. And in today's environment, with interest rates that keep on, have gone up significantly over the last 6 months, and just people's concerns about the environment, showing them solutions that will be creative for them is the most important thing that I feel that we can do for a client. And that's a deep dive into their finances, not asking them just a couple of questions, really digging in deep and finding out what's going to be most important for them. If I am with someone and I'm talking about buying down the rate, but they don't plan on staying in that house for 3 years, the ability for them to make money and the return on investment for them is not going to be there. So you have to understand what they're going to do. And that's really big with down payment assistance, because there's caveats to it that will help and to hurt. Let me hop into the chat real. I just saw something in the chat real quick.
Yeah.
So how can a seller offer to buy down the interest rate for the buyer? How does the listing agent word that in the listing to ensure he uses the money for buy down? If you get a seller concession from someone on a listing contract, on a contract, the buyer can use that money as they please. It doesn't have to be earmarked necessarily for buy downs. It is essentially a closing cost. So that is all there would have to be. So seller contributions are starting to come back, I hear, which is exciting stuff for buyers. So that's something that they can absolutely do. It's going to usually be worded in a percentage amount, or it can be worded in a dollar amount. So it just depends on how the contract is written up. Have you guys been seeing more seller contributions on the table?
We have, but I just want to make sure it's clear in this, because some people haven't been around for those seller contribution days, right? So our builders buying down rates, I mean, so anyway, to answer this question, okay, let's pretend is not a builder, right? Let's pretend it's a regular old property. If the property doesn't appraise, that credit's typically going to go away quickly. Okay. So if they, don't everybody on the call, like, please don't misunderstand. Run your comps as a buyer's agent, right? See if it should appraise. I always give this caveat of the appraiser is a wild card, right? 2 different appraisers, 3 different appraisers can all look at the same comps, pull the same comps, and get different numbers. Okay. Small little example, but in the small little examples, that's when it makes a big difference. I had a property going to contract for $190,000 in Lakeland, and they said they'd bring an extra $5,000 at closing. He's like, all right, cool. It had appraised before for $188,000. And then when the new appraiser came through, it had then appraised for 180. They used the same exact comps, came up with different numbers. So the seller basically lost out on $5,000 because again, same comps, different numbers, right? So anytime you give seller concessions, you know, 10 grand, 5 grand, whatever the case may be, the general rule of thumb is, you know, I don't want to get into that. We got the lenders on the line here. We don't need I'm not going to get into that. But yeah, that's the first thing to go. Okay, if there's an issue with an appraisal, that's the first thing to get just removed from the table. So if they're really relying on that to get the loan, and it's not just something convenient that they would not like to pull money out of their bank account, then that potentially is going to fall apart if they don't have that backup net or something. They don't have money in the bank to cover those costs in case the appraisal like removes that, right? Does everyone understand that? Okay, I'm gonna assume everybody said yes. And then John asked the question.
I have a question.
Yes, Faith, go ahead.
Okay, so they're not, the people that are asking for seller concessions, that's at the contract level. You're not putting it on a listing, right?
Well, no, you could put it in the listing. That's something to make it more appealing. You could put it in the agent remarks. Excuse me,
Okay.
agent remarks and regular remarks, right? If your buyer is looking at the listings you're sending them and they're saying, seller is offering $5,000 towards closing costs. Oh my gosh, you know, that was going to be really tight for us. You know, we were wondering like how we were going to be able to buy stuff for the house, right? We wanted to buy a fridge and washer and dryer and ceiling fans and everything like that. And now we can use that money for that.
Mm.
You know,
But it really does go towards the closing costs.
right. I'm saying they have the closing cost down payment saved, right?
Oh,
let's say
yes,
30
okay.
grand or so, right? And so they have
They
money in the
save that
bank,
money. Okay.
but they prefer to use that money towards the washer and dryer and fridge and blinds and whatever else, right?
Every day is a busy day for me.
That's right. Reginald, can you hit me, please?
I say that, I mean, because I do.
Thank you so much. I love your wife's voice. It's beautiful. It's not relative to the topic at hand, so I appreciate that. All right, thank you, sir. Okay, John had asked the question, are builders buying down buyers' rates? Go ahead, Garrett. That's for you. That's directed towards you, sir.
So I'm trying to think of the nice way to say it, because builder world, if you ever get into that, typically, especially in older economic environments where things were a little bit rosier, they would give a lot of money towards closing costs. The way that loan officers were told to sell that was because the rates were significantly higher with the builder. So you will get X amount of dollars from the builder towards your closing costs if you use our preferred lender, typically Lennar Mortgage, DHI Mortgage, Pulte Mortgage, etc. Those interest rates were typically between 1/4 and 1/2 point higher. And then the selling point would be you can use some or all of those closing cost concessions you're getting from the builder to buy down your rate. So essentially we're going to give you 10, but we're going to make you use 5 to 7 to buy down into a competitive environment.
Okay. But Garrett, you forgot to use your air quotes. We're going to give you, right?
Yes, no, it's the builder world was fun. I really enjoy that a lot, especially just working with the buyers through the whole process. But everything was all fine and dandy until you got that letter from the builder that says that we will be closing in 4 to 6 weeks. And that was the builders or the lender's cue, air quotes, to lock the interest rate because they knew when the loan was going to get done, because we all know that supply chain things aren't really turning out the way they are. The call that I had yesterday, besides that DPA, was about a buyer who their situation had changed and their house was supposed to be done in 8 months, and we're on month 17 right now.
Oh,
And they're about 6 weeks away. Most builder contracts allow them for up to 2 years to provide you a home. If you've never seen it, almost all of them. It's not a FAR bar contract, it's a bar contract, bar smacking. So it's very sided towards the seller. So this person, downturn in the economy, self-employed, things like that. We're working to try and find creative solutions, which we'll talk about in a minute, which is non-QM products. I'll explain all that stuff in just a few minutes.
We have another question in the chat. Before you get into that, I just want to cover this here. So can the listing agent place that the down payment is, or not down payment assistance, the closing cost credit in the public remarks and attempting to get the buyer into a certain payment each month, seller offers 3% credit? Yeah, that's where I'd advise that you do it, because you want to make it known to the buyer, right? You don't want to just put it in the private remarks. I'd put it in both, or the agent remarks or the realtor remarks, whatever it's called. I'd put it in both the public. There's nothing wrong with doing that, right? So typically a conventional loan, right? Garrett, back me up here. Conventional loan. I'm sure there's some caveats to this and everything like that, but I'm just saying conventional FHA. Conventional is typically up to 3%, right? FHA is up to 6%.
Conventional has multiple tiers, so 10% or less than 10%, 3% closing, 3% allowed for seller concessions, up to 24.99%, it's 6%, and then above 25%, it's 9%.
Y'all got that? Because that was super confusing. Let's break that down again.
There's 3 different tiers.
one at a
So
time.
if the down payment is less than 10%, then it could be up to 3% seller contributions. From 10%,
The normal
10%.
owner occupant is doing maybe 3% if their credit score is super duper high, 5%, 8%, up to not at 10%, but below 10%. You're talking the maximum allowable down payment assistance, or not down closing cost credit that they could get to use to pay down the rate or anything is 3%,
correct.
right? 10% to 25%.
24.99 to be exact, is 6%.
Okay.
And then anything
6%.
above 25%, and I've never seen a 9% seller contribution, but that is just the rule. And there are things, and those are for non-investment property purchases as well. So that is owner occupied.
Okay.
Investment properties are always capped at 2%.
Good to know. I was just thinking 3% conventional, 6% FHA.
Just like FHA is up to 6%, there's no down payment minimum maximum. VA is 4%, but there is a air quote for that. You can add so many things in the seller contributions. VA loan is fantastic. It provides so many advantages for the borrower. I've added in paying off leases. I mean, with the builder side, especially to get the deals done, we've done some really creative things. Paid off cars, and that was included and allowed.
Okay. Now hold up 1 second here, because I want to make sure everybody is listening to what Garrett is saying, because
And I'm also going to send out a recap later on too, with a little 1-page QRG to everybody.
Okay, cool. Thank you, Garrett. The majority of people that I talk to think that VA loans are the scum of the earth, right? They have zero money to put down. They are just lazy bums. It is super duper hard to get a VA loan done. So for the people who are now listening, I'm staring at everybody, including people in wedding dresses. I'm just kidding. Emily, I can't see if your eyes are looking at the screen or not. I'm just kidding. So now that we got everyone's attention, can you please repeat about VA loans?
It's the best loan program out there, hands down. There is no difference. The only thing that may take a few days longer is the appraisal, because unlike the traditional appraisal process, you have to go directly through the VA, and they have typically 10 to 15 days to get it done. I think it's up to 15. So that's something that may take a little bit longer. So that's one of the things that you should always do as a lender. The things that are out of your control, you get done first. So get the deal, order the appraisal, get it done, get that off the plate so it comes back early. But it is bar none the best loan program out there. Very liberal on debt to income ratios. I've seen some crazy numbers get approved eligible through our automated underwriting systems. It's bananas. Back end ratios hovering right around 80%.
Oh my God.
It's
Right.
not something that I necessarily feel comfortable with, but if it says that, it is. But it's And that's typically a well-qualified buyer that's a lower, has lower income streams. But
Okay, so-
has demonstrated the ability to, manage their finances and their resources in a very applicable way for that loan program.
So I hear this all the time, there's all these condition requirements for the property for a VA loan.
Not necessarily any more than an FHA. I mean, it's a little bit more protection for the buyers, and that's what FHA and VA say. I'm gonna start using air quotes all the time now. But little things like with conventional, you might get away with some wood rot around a garage, not with if the appraiser sees it. Those are things that can typically happen. Ages of products, not much more.
What if this is like a well-maintained home with a good roof, with there's no wood rot, there's no peeling paint, there's nothing weird going on. This is just a regular home in, I would say, 90 to 95% well-maintained condition. Is there going to be any problem with it?
No.
What about the termite inspection? The seller having to pay for the termite inspection?
Okay.
Is that the only person that can pay for the termite inspection? Because the buyer can't pay for it, right?
No. No, it's no, I think that everyone gets scared about VA loans because they've heard something in the past. And I've been in the lending space for 12 years now. And it's always been the best loan program, and people shouldn't be scared away. I know that everyone hears that, if we offer FHA or VA, we're going to be last on the totem pole to get looked at if we're in a multiple offer situation. It shouldn't be that way. If you have a client that's looking to go with a VA loan specifically, best way, just like with any loan program, is to get that buyer fully pre-approved before you start going out and look for a property. Have a lender like myself fully underwrite the deal, give you a pre-approval, have that ability to reach out to anyone throughout the process to say, hey, this is a fully vetted buyer with excellent income and assets that is fully approved. We just need a property address to add on, get the appraisal going, and let's go.
So I'm new to this fully approved thing. This all sounds great, but I don't really understand what it means. What is a fully approved buyer?
And I know any lender can hear this, that not all pre-approvals are written equal in the first place. And many pre-approvals from people, especially on a weekend, they haven't looked at income docs. They have no idea what the buyer made. They're going off of verbal. Oh, do you have money in the bank? Oh yeah, I got money in the bank. Cool. They type a piece of paper out and they send it out. Then when the deal gets done, you put your work in, and then the stuff comes to me or to whoever lender that is, and they're like, whoa, this isn't what you told me before, and you don't really have a deal. So the difference between pre-qualification and pre-approval is when you are pre-approved, a buyer comes to me and says, hey, I want to buy a house for $350,000. So we are going to work under the assumption that $350,000 or less is what they want. We're going to get all their income docs. We're going to get all their asset docs. We're going to run the automated underwriting, get all the information that we need to make an educated decision. We send that to underwriting it like we're in the full process, but the address says PDD because we don't know what it is yet. So when that comes out and it's approved, that means that if you stay at 350 or less, all we're going to need is an address. We're going to fill out the 1003, which is the mortgage application, and we're going to order the appraisal. And then everything's all done. So basically, typically I'm going to want to wait if the buyer wants to do the inspection first to make sure we don't incur the cost of the appraisal. But let's, it just gives you more buying power and essentially puts you at the level of cash. And that's where everybody wants to be because, cash buyers go in, but they go in with a little bit less money. Hi, Mr. Seller. This is essentially a cash offer because we have vetted and pre-approved it, reviewed the buyer's documents, reviewed automated underwriting, and good to go. If you accept this offer, we'll be in contact every step of the way. Do you want to schedule closing for 2 weeks?
Okay.
I would say 21 days for a VA just because of that time frame for the appraisal.
Right.
It's always under promise, over deliver, but for any other loan program, 14 days, good to go.
Okay, so an underwriter approval is simply all the stuff they typically do with the lender to get fully approved. They just do that up front before they get the property under contract. Is that right? Is that a good summary?
Correct.
Okay, cool.
Yeah, so
Um,
that's ultra important in this environment, and it gives you, puts you in a position of power. And that's
Okay.
what we all want to be in. So that way, and you can always have that seller's agent contact me. And I'll,
how long is
not
that
give up.
approval? How long is that
not
approval
double-
good for?
I'm sorry,
How long is that approval good for?
typically 90 days.
90 days. Okay. And going back to this, because I just want to make it clear, the termite inspection doesn't have to be paid for by the seller. Okay.
Correct. Jeremy,
Go
that
ahead.
can be paid by the seller, the buyer, or the lender in Florida. It depends on the state. All the rules are different, but in Florida, buyer, seller, or lender can pay that inspection.
Or the buyer's agent.
Probably.
I do it for my VA buyers. We cannot, just so you all know, we cannot charge them a transaction fee, right? That's the cost of them being our heroes. We cannot charge them a transaction fee, right? And then I also offer to pay their termite inspection. So just so you know, so that's whenever I get a hero is what I call them, right? Somebody who served for our country, I say, transaction fees waived because you can't charge it anyway, right? You might as well spin it as a good thing. And I'm going to pay for your termite inspection too. So, so yeah, it doesn't, a lot of times that listing agent will make the objection of, hey, we don't want to accept a VA buyer because we don't want to pay that termite inspection. Okay. So if that comes up, be like, hey, we're going to cover it. I'm going to cover it myself. You don't even have to worry about it. It's not going to cost your client any extra by taking a VA buyer. Okay. Garrett, please. I'm sorry, I'm hijacking your whole presentation here. Can you
No,
please?
this is the conversation thing, exactly what I wanted, because this
Go
is
ahead.
real world information. It's much better than staring at a PowerPoint presentation for a little bit with hearing a voice behind it.
All right, good. You had some was it non-QM? I'm gonna screw up the terminology. Please tell me.
And so what non-QM means, and it actually ties into that second scenario I was just talking about yesterday, because they both literally came up on the same call. Non-QM is non-qualified mortgage. So it is a solution mortgage product that is not a conforming loan. So it's not going to go through Fannie or Freddie. It fits outside of the box. Many lenders, I'd say a lot nowadays, like to stay inside of that vanilla box, that, conventional FHA. When it starts veering outside, they get a little bit nervous and advantageous. So I spoke with this buyer yesterday. I'm actually meeting him a little this afternoon with this solution because it does appear it will work for him. We're going to go with an asset depletion loan for him. So he's a high net worth buyer. He's I almost dropped the name of the community, but it's a heavy one in the Windermere area. The purchase price of the property is 1.4 million. But he is a very high net client. So
Okay.
what we're able to do is put him into, and he's not liquid, and he's got some liquid, but not a lot. Not crazy. But we're putting him into an asset depletion loan where we're using his bank statements and basically proving that he has the money to pay the loan. So it is a much different solution with the qualification products, and it depends on the investor that you're using. And the interest rate is not going to be the same as a traditional, conventional loan. You're getting a niche product, so you're getting a niche rate. I don't ever break bones about that. That's kind of what happens. But this is a solution that's going to get him in. We're going to be putting this gentleman into a 3-1 ARM. So it's going to be a 3-year adjustable mortgage with the intention that in 24 months, he's going to refinance out of this solution into something more conforming.
Okay, and weren't you tell me about some doctor, maybe plastic surgeon or something like that had, that made a lot of money but wrote off the majority of it?
Oh, you listen to my stories. So I did a loan for a prominent LASIK eye surgeon in Florida. On paper, on his tax returns, millions and millions and millions of dollars. But after all the deductions and the things that we as loan officers have to do, which make us about as known around the industry as a used car salesman sometimes, his actual adjusted gross income was $27,000.
Oh,
So number one, I had to explain it to him. He didn't like that. Number two, we had to work around it. And we did. This was many years ago. This is pseudo almost had hair then. 2 days before closing, his wife bought a Porsche Cayenne. And of course, we checked credit right before, knocked him out of scope. So I hate this. It makes me sound so bad.
no, I love this story.
I was in the passenger seat with her as she was crying, taking me back to the dealership. It was a temporary thing, just 2 days. Just drive your old Porsche for the next 2 days. Look at your new one.
The sacrifices we make for homes.
And she's like, why? I'm like, can you fit all the furniture from your house into the trunk of your new Porsche? That was essentially it. So that wasn't necessarily a solution, but that was and that wasn't a doctor loan. That was just a crazy loan, but we do have doctor loans available to help offset those high costs of student loans for our doctor friends. That was a good story. And the irony, my ex-wife works for that guy now. I'm not even kidding. It's the truth.
Oh, that's funny.
Which we're still
Okay.
good.
We got another question in the chat.
Talk about working your sphere of influence, Garrett.
All right. I want to market to your sphere. Is it mostly used for high price homes, like the QM products, right? Is it mostly used for high price homes, or with buyers with lots of assets?
Not at all. And this is the beautiful thing about some of these programs. So let's say you're a small business owner, you've been in business for 5 years, you're building up. You may be making good money, but you're taking a lot of deductions to ensure that you're not paying Uncle Sam a whole bunch of money. You want to keep that money to yourself. So on paper, you don't appear to have a significant amount of income. We can use these other programs as well, depending on your personal financial situation, to help you get past the bridge to be able to get on top of that. So it doesn't have to be high net worth. It can be. Sometimes that makes it easier, but sometimes, as we just heard, it can make things more difficult. It's really up to the individual borrower. And of course, you're always going to want to go the conforming, the conventional loan, whatever the case may be, go with the traditional product to get you the best interest rates. But through discovery in our industry, we have to determine early if we have a viable solution for that buyer, whether it be that conforming product or if it's in one of these QM solutions that is there. The whole matter of wanting to bring this up was that, many people, especially if you're newer in the industry, you may not know that some of these things are out there. So as a lending professional, please lean on me and allow me to service you to make sure that I can find a solution for your buyer. Once you find that buyer, let me help you turn that buyer into a homeowner. That's my job. And that's what I love to do. And that's why I got in this business. So having solutions, having the ability to understand those products, and there's a lot of things behind the scenes, and I could go on for hours and hours and talk about these things. But I want to go through just a high level overview with you guys so you have the knowledge to know that the products are there. That there are solutions that may fit outside of that traditional lending box that you're familiar with, because that's what we always hear about, the conventional, the FHA, the VA, not so much USDA though, but it's still there. But there are additional solutions out there to help people out. I mean, we have solutions for investment buyers to help them use deferred interest to help qualify for loans. There's crazy things out there. And over the course of the next few months, I hope to be able to come back here and talk to you guys about, more in depth into these solutions. I kind of wanted to put it out there today that there are some additional things available, whether it's down payment assistance, which is, less finances, or non-QM, which can be more, or even in the middle. There's just a lot out there. And when the rates went from, 3 to, mid fives, it scared a lot of people. They're like, oh, the market's done. I'm not going to qualify. And for some people, that's true. Excuse me. In the case of the builder world, their job is to write contracts as sales managers for these builders. So for an FHA loan, you can go up to 57% on the back end, 56.99. So if your interest rate, if your interest rate is at 3%, I'm sorry.
Can you explain what that means, the whole back end? It was years in the real estate industry before I actually spoke up and asked that question. So what does that mean? 50.
So with any loan, there's going to be a debt to income ratio. There's a front ratio and a back. The front ratio is your income divided by the new housing payment. So principal, interest, taxes, insurance, HOA. So all those things associated with your mortgage payment. The back end ratio is your income divided by the home payment and any liabilities that are on your credit report. So any other mortgages, any other vehicles, credit cards, anything that's on the credit report.
So when you say divided by, you mean minus?
Or divided by. So not this, well, it's divided.
Okay. All right. We do have another question in the chat. Do you have attorney loans that are similar to doctor loans?
If they're out there, I don't believe I have one. I've actually never been asked for one before in my years. So the best answer I always like to give is I don't know, Libby, but I will find out and let you know.
All right. Thank you, sir.
I've never heard of an attorney. I'm not in the mortgage. Well, I am in the mortgage business in a sense, but I've never heard of an attorney loan. I have heard of loans for doctors, nurses, specific programs for them.
Sure.
Yeah.
And we do have those as well. So we do have the doctors, just not the attorney ones that I've heard of. So I just don't want to give the wrong answer because I might get litigated.
I've never heard of one either.
Yeah, it's
I like Shane, just it pops up on camera real quick, his head shaking no, and then it goes away. That's hilarious. Anyway, it kind of makes sense, right? Because they have all the school, the school debt and everything like that. So attorneys would have a similar debt load.
yeah, I'm gonna find out on that because this is the truth as well. Not every lender can do every loan. That's just if you can do every loan, if a lender tells you they can do every loan, turn around and run.
Yeah, I have a question about student loans. I saw something, I don't know where, it could have been a TV commercial. I don't know where I heard it. It's something about student loans being removed from credit scores. Is that right? Anybody heard of that?
No.
I don't believe it.
No?
It's medical bills. That may have been what you heard about.
Okay.
I think I've heard that, Freddie, but I don't believe that to be true. I'm like, student loans are like taxes. Like there's no getting away from them. That's why the interest rate's so low.
I think I got a message about it once, but it had a link to a malicious site, so I didn't click.
They are changing the guidelines to deal with those medical collections as Garrett referenced, and that's coming down the pipe imminently.
That's cool.
No, absolutely.
That's huge.
Which a lot of medical student loans kill loans. People don't realize when you have to calculate them, and especially, I went and got my master's degree, so I had a little bit of debt, and I was refinancing the house. It didn't affect me, but when I looked how it changed the ratios, it's a little bit interesting. So people don't realize those, and just because your student loans are deferred doesn't mean that we're not going to provide a payment for that. So that's what people need to realize as well, that if you have $75,000 in student loans, but I don't have to pay them back, I don't have to start paying until next year, we're not going to pop a zero in there.
You got that, Nikki?
Actually, the article about it's in Forbes magazine, and it's Biden makes it easier for student loan borrowers to get a mortgage.
Well, they did drop some of the percentages a little bit, so that may be what it is. That's
Okay.
They did make some changes to lower the amount that I was just talking about that we have to input basically in half.
Got it.
So
Thank
that
you.
does help, because it used to be for many times it was sometimes 1% of the income, or 1% of the payment. So if you had $100,000, dropping that 1,000 on there is not, real good towards debt to income ratios. And I've seen some interesting things. I know. I mean, I can't tell you how many times I've seen somebody making 40 grand a year with a $1,600 car payment. And it hurts, just like the person, what do you mean I can't get a loan? It's kind of like the SATs. I think you get 300 points just for having a name for your credit score, and then you add like 50 points to that. I've seen some things.
Wow. But we all have to go to Glenn's house and chill out at the tiki bar, apparently.
I'm sorry. Nope.
Kick it up, he's got his feedback. I love it. That's how we all need to be living there. All right. Cool.
Yeah, but the most important thing, everybody, there are a lot of solutions out there. And, if you need, we're here to help out. Feel free to give me a call. I'm going to send all my information out to everybody today if you don't have it already. Just here.
Hey, Garrett, Nikki's got a question out here. It says, is it easier for gig workers too? I don't know what a gig worker is. What is a gig worker?
I don't know, Nikki can
Typo.
help.
Uber. Oh, Julia says
Gig worker.
Uber. Okay.
Like tipped employees.
Oh,
Tipped
tipped
employees,
employees.
I mean, that's the commission-based employee, so that's going to be using a 2-year average. So just like with any variable income, that's variable income. So commission, overtime, bonus, tips, things like that, those have to be used over a 2-year period in almost all circumstances. So it just depends if they start in the middle of a year and then they got the next year, of course. And if we're using a 2-year average and year 1 is lower than year 2, and so year 2 is increasing, we're going to use that average of those 2 years. So we're going to add them both together, divide by 2. If year 1 is more than year 2, we're going to only use year 2 because it is decreasing income. So it's always worst case scenario in the most part in the industry. So we always try to do the best we can, but we always happy to look at the numbers, and we have multiple tools to help out with, devising plans and what people need to know, because many times, especially in tips, they might make 50,000 in tips, but they might claim 20 of it only. I can't use that 30 that's cash. So that's that mattress money. So just got to make sure that it's all on paper, and everybody doesn't want to pay Uncle Sam, but sometimes you have to bite the bullet.
I thought they were making it easier for them to get loans. And I'm not sure why or how.
I haven't really heard any difference on any particular industry like that. That sort of variable income is kind of standard across the board and how it's looked at. It could be, I haven't heard any real differences on like the Uber drivers and things like that now. Well, I'll check this out.
You don't have an Uber loan?
Uber loan program. Well, I
Only
guess I'm gonna
only
stop driving
DoorDash, not
Uber
Uber.
then to qualify for my house, Garrett. Thanks a lot.
At the end of the day, an Uber is considered an independent contractor, right? 1099.
Yes. I do have a Drizzy loan because I do get some drinks delivered every now and then. Just kidding. But yeah, in variable income, it's standard across the board. So commission-based employees, especially just that 2-year average. So keeping track and yeah.
So Jude is saying we qualify as gig workers.
Yeah, commission-based employees. So absolutely, that's the way that it works.
What? This is brand new information. Gig workers. Yeah. Yeah.
Hey, so any other questions or comments or things that you want to know? You got the pros online right here.
The ARMS loans are getting more popular now.
They are. You typically see an upswing in situations like this. It just depends on the buyer if it's right for them. It might be a little bit of a reduction, but if they don't have the ability to get out of that loan eventually, the caps could come back and bite them because they will adjust over time. So it's anything with loans, there's a lot of generalities, and that's what I'm really trying to talk about here. But if you ever have any scenarios where a customer wants to talk, typically with me, the buyers who get ARMs come to me with the knowledge knowing that they want to get an ARM. It's Hi, I'm going to be living in the United States for 2 years, and then I'm going to be moving back to Europe. So I know, and they're steadfast in that process. So that way we know that they're not going to be in that loan to work to adjust later on down the road. And the market it's a little bit different for the interest rates, but not a crazy amount. It just depends on that individual buyer. And that's why it's so important to ask the right questions as the lender up front. We don't want you guys to have to ask too much into the lending environment. I'm also I have my real estate license as well. But if one of your buyers talks to me and asks me a real estate question, you know what I'm going to tell them? Talk to you, because you're their expert. So I just want to be at the point to where you can feel comfortable using me as the expert and giving us a call and letting us take care of your buyer and finding a solution for your needs, because there's not a one size fits all loan. There's so many different variables out there, and there's so many roadblocks that can come up along the way. And that's what our job is to mitigate the issues that could potentially come up and make sure that it's a smooth transaction. Because many people in lending know the buyer signs the contract, they're super happy. They close on their house, they're super happy. I am that guy in the middle that is asking for all the documents, doing that. So our job is to make sure we only ask for documents once, unless it's required, and we'll explain it, because in a builder environment where it's a 12-month build, documents do expire, so we may need to ask for them multiple times to keep the approvals going. But our job is to make it as easy as possible for your buyer to get a loan. And that's, for me, that's not using industry jargon, using real world terms, and just making sure that they feel comfortable throughout the process to ask questions. And that goes back to why I got into lending. So back before I got into lending, I was a regional manager for Verizon Wireless. I was buying my first home. This was in 2003. And they had a promotion that if you use this certain national lender, that you would get $5,000 for your closing costs. I'm like, wow, that's a lot of money. That's really cool.
Winning.
I'm sorry?
I said winning.
Yeah. So I didn't win. I lost big time because I knew nothing about the mortgage process. This was when the crazy loan programs were going out. I had never done anything with mortgage and anybody to help. I got thrown into a 10-year interest-only loan. And 3 days before closing, because this was also in a crazy purchase time where it was the seller's market completely, and I had a $10,000 contingency that if I did not close for any reason, I had to pay 10 grand straight up. Lender said, I made a mistake. It's going to cost you $27,000 more to close. And you know what I did? Wrote a check for 27 grand, sat in my new living room and cried. Right. So it was lesson learned. So I knew that when my time with Verizon was over, that I wanted to do something to sell with substance and to sell something that would actually matter and to care and to make sure that no one ever felt like I did at that moment. So it's always buyer beware, and I learned a lot from that. That was a pretty expensive lesson. There's also a lot of laws that were put into place, which ensure that will never happen to people again.
All right. Well, thank you very much. Anyone else? Any other questions? I had a similar experience when I bought my first home in 2005, where they're like, oh, we were wrong on the closing costs. You need to bring an extra, like, I don't even remember. It was like 5 or 8 grand or something like that.
And
Like,
then
how does this
another
happen?
good thing to remember, and at that time frame, I had an 802 credit score and my interest rate was 6.375. So with interest rates now, the sky is not falling. If you've never looked, look at what the average interest rate was in 1981 and sit down. It was near 20%.
That's correct. When my parents bought their first home, I think they were at 20 or 19%, anywhere between 17 and 19, something like that. Yeah. So, and they were getting a good deal.
Yeah, that's the thing nowadays. People they're like, oh, rates are crazy. No, it's in the eye of the beholder. Tell that person from 40 years ago that, and they will just laugh in your face. So yeah, it's, when the time to buy is right, when it's ready for you. That's what people, what is the interest rate? What is that? Look at the monthly payment. If the monthly payment is good for you, it feels good to you, your budget, you can handle it, go. It's never gonna get better. This is the industry where you buy something and it appreciates almost all of the time. So this is the best investment tool you can get, and that's what we're here to do, is to help them get into a home and to help you close loans. We want to help you close homes. That's my job.
All right.
Hey, so if nobody's got any questions or I just want to make some quick announcements. Don't forget our Nokomis branch lunch this Thursday, 11:30. We switched the venue. We are going to be hanging out at Pop's Sunset Grill. So come check us out. Come hang out with us in Nokomis at Pop's Sunset Grill. And then next Thursday, we'll be in the Tampa area. So look out for the announcement on that. Actually, we'll be in Seminole, close to our Seminole branch. So we'll be close to Sarasota, Bradenton, Clearwater, all that, or a little closer, I should say. So look out for those announcements. See you on Thursday. Oh, no contracts training tomorrow, right, Jeremy? We have a conflict in our scheduling. So no contracts training tomorrow. We'll pick it back up next Wednesday, 10 a.m. And any other announcements?
We got another question that just popped up in the chat. On a side note, can I ask the group in inspection, why does settlement cracks in the suit? Somebody just knocked off the, does settlement cracks in the stucco get flagged the inspection? Isn't there all right.
Why don't we just have Julia unmute? Julia, unmute and ask your question.
Come on.
Hey there, sorry, I have a typo. So in an inspection, why is settlement cracks so important here in Florida? I'm not getting that, because every house seems to have it, but yet it's a big sticking point for the buyers when it's just kind of superficial, you know what I mean? Like when they fix it, a painter will just patch it and paint it and move on. And it's the settlement crack is still kind of there. You know what I mean?
If it's bigger than, like, you could slide a quarter in there, I've heard that's like the concern. If it's just like a little hairline crack or something like that, that's just lack of painting and maintenance, So if water is actively leaking through the brick, then that's a problem too, But yeah, if it's just, so people do get, because inspectors will notate it, right? And they're like, oh, the house is falling apart, right? That's the concern. Or it's in a sinkhole and the house is starting to sink and that's why it's cracking. And so that's the concern, right? But then you say, hey, it's only a bigger deal if it's, you can fit like something in there, or, it's larger than a quarter of an inch or something like that. Then there could be underlying issues other than just basic settling or lack of maintenance, lack of paint job, that sort of thing.
Okay, so hairline is okay. Bigger than a quarter, no good. Okay, thank you.
Mm-hmm. Any other questions? We're around.
Hey, Jeremy, I got a chart that I just want to show everybody real quick before we let off.
All right.
I think this might. So I'm trying to. Can you guys see that?
Yes.
Okay.
Oh God.
This is to Garrett's point earlier. We're talking about interest rates. Just look, guys. I mean, there was a run here for sure. 2012, and there were some great rates, but 7, 8. The market is not terrible. There's a lot of opportunity out here.
But don't you know the crash is coming?
All right, that's all I had.
No comment.
Hey, real quick. So Reginald, are you asking where is Nokomis? Nokomis is right next to Venice Beach, Florida. So Google Nokomis, Florida. It is literally on the border with Venice Beach, Florida. I want to say it's south of Sarasota.
I wasn't asking. Julia had put in her comments, where is the
Oh, okay. So I know.
so that she know how to spell it, so she'll be able to look it up.
Okay. Well, we're going to wrap it up there, everybody. Thank you all for attending this this session, sure, let's go with that episode. This session of Coffee with the Broker. Thank you for all your questions and your comments and your interaction. Emily, again, great wedding dress. I love it. Don't change a thing. Everyone have a fantastic day. Bye now.
Have a good day, everybody.
Thanks.